On paper, this company held £28 million in cash. The real number was closer to nothing. Between them sat a whole of £94 million. This is the story of Patisserie Valerie, the cake shop that cooked its own books, a beloved British institution on nearly every high street, 200 stores, 3,000 staff, cakes in every window, and behind the buttercream, thousands of false entries in a hidden ledger. By the end of this file, you will see the exact fake check that held it all up, and one uncomfortable question. How does a company invent money that isn't there? Keep that in mind. The answer is almost absurdly simple. The story starts not with a fraud, but with a genuine success. The first Patisserie Valerie opened in London in 1926. For decades it was a single charming cafe. Real cakes, real customers, real charm. Then in 2006 an investor named Luke Johnson bought it. Johnson was a star of British business. He had already turned Pizza Express into a fortune. He saw the same magic in cakes. Take one loved shop and multiply it. And multiply he did, from one cafe to over 200, Drucker's, Baker and Spice, Philpotts. The empire absorbed rival after rival. In 2014, Patisserie Holdings floated on the London stock market. The shares doubled. The city loved a cozy, profitable, very British success. At its peak, the company was valued near £450 million. Every report showed the same thing: steady growth, rising cash, no debt. That last part, no debt, was the detail everyone admired most. A company swimming in cash with no borrowings. In modern business, almost unheard of. It was also quietly, completely untrue. Here is how a lie like this is actually built. It is not clever. It is just bold. Start with a real working business. Cakes really were sold, money really did come in. But the numbers reported to investors were quietly, steadily inflated. Sales made to look bigger, costs made to look smaller, profits invented, and the cash that impressed everyone, it was propped up with fiction. Thousands of false entries, checks recorded as received that were never cashed. On the books, the money existed. In the bank, it did not. To hide the gap, the company ran secret overdrafts. Bank accounts the board never knew about, nearly £10 million of borrowing invisible to the very people running the company. So on paper, a cash-rich, debt-free darling, in reality, a shop running on empty. For years, nobody looked closely enough to notice. The auditors signed off. The board approved, the share price climbed, and the people at the very top kept selling their own shares. In early 2018, as the shares hit new highs, insiders cashed out. The chief executive, the finance director, a board member, around £6 million sold. Months later, the board sold another £7 million of stock. The public was told again and again that the business was performing beautifully. Rivals were closing stores. Patisserie Valerie insisted it was thriving. One financial journalist noticed the timing of those share sales and asked a simple question. If the cakes were sinking, why couldn't anyone in charge see it? The answer arrived on October 10, 2018, a Wednesday. The company suddenly announced it had found accounting irregularities. Trading in the shares was frozen within hours. The finance director, Chris Marsh, was suspended, then arrested on suspicion of fraud, and the true state of the company began to surface, one horrifying layer at a time. The chairman and biggest shareholder was Luke Johnson himself. The man who had built the empire now had to save it in a single weekend. Without emergency money, 3,000 people would lose their jobs on Monday. Johnson personally loaned the company millions to pay wages and keep the doors open. For a few weeks, it looked like the beloved cake shop might just survive. Emergency funds were raised, shops reopened. The story seemed contained. The early estimate of the whole was around £20 million, painful but survivable. Then the forensic accountants kept digging, and the number kept growing. 20 million became 40, 40 became more, and then the administrators delivered the real figure. The whole was not 20 million, it was £94 million. The company had claimed 54 million in cash it simply did not have. £94 million, enough to run every shop for years, gone into thin air. On January 22, 2019, the rescue finally failed. Patisserie Holdings collapsed into administration. 70 stores closed. 900 people lost their jobs overnight. One employee said everything had seemed fine. Right up until the end, that was the cruelty of it. The shops were real, the cakes were real, the staff were real. Only the money on paper had ever been fake. So who did this? The investigators followed the paper trail into the ledgers. At the center stood the finance director, Chris Marsh, the man who signed the numbers. The man who knew where every entry came from, but investigators did not believe he acted alone. Years later, charges named 4 people: a conspiracy to defraud, the finance director, his wife, an accountant, a financial controller, an outside consultant. The charge: conspiring to inflate the cash on the balance sheets for years, providing false documents to the auditors. So the lie would pass inspection. All 4 denied everything. All 4 pleaded not guilty. The trial for this cake shop fraud began in March 2026. As you watch this, a jury is deciding what really happened inside those books. But there's a second question the trial cannot fully answer. What about the men at the very top, the chairman, the board, the auditors? Luke Johnson owned over a third of the company. He sat as chairman. He has always said he was a victim too, deceived by secret accounts he never saw. He wrote that he considered fleeing the country, that he feared becoming a pariah. And critics asked the obvious question in return. How does a chairman, a major shareholder, miss a £94 million hole? The board should have seen it. The audit committee should have caught it. And the auditors, Grant Thornton, had signed off the accounts since 2006. 12 years of approvals, 12 years of a growing lie they were paid to catch. The auditors later faced record fines and legal action for what they failed to see, because that is the deeper lesson of this cake shop. Fraud this simple does not survive on cleverness, it survives on trust. Everyone trusted the brand. The cakes were lovely, so surely the books were too. Investors trusted the reports. The reports looked immaculate. The board trusted the finance director. He was one of their own. The auditors trusted the documents. The documents were forged. Trust is the ingredient every simple fraud is actually made of. The remains of Patisserie Valerie were sold for just £5 million. A company once worth $450 million, gone for barely 1% of that. Some shops still trade under the name today under new owners. The cakes are still real. That was never the problem. The problem was that a beloved name became a lesson in how easily numbers lie. So decide for yourself. Who really cooked these books? Option 1, a finance director in a tight circle who forged the numbers alone, signing false checks, hiding overdrafts, keeping the whole board in the dark. Option 2, a system where everyone above simply preferred not to look too hard, a chairman collecting the glory, a board waving reports through, auditors ticking boxes. The court will judge the 4 in the dock, but the failure was much wider than 4 people, because a simple fraud needs a room full of people willing not to ask. Patisserie Valerie did not fall because the cakes were bad. It fell because a piece of paper said there was money and everyone believed the paper. The most dangerous lies are the ones that look boring. A number in a spreadsheet, nobody double checks boring. That is exactly why boring is where fraud hides. One detail still lingers. Those secret overdrafts were opened in the company's name. Somebody arranged them. Somebody signed, and the full chain has never been laid bare. So you be the jury the story never fully had. Lone forgers, or a whole room that chose not to see. Say your verdict in the comments. The court is deciding the 4. You can decide the rest. And those auditors who missed it for 12 straight years, their story is the next file.